Welcome back to Origins, our bonus Minisode edition. This is the podcast that dives deep into the business of venture capital, where we learn how the people behind the capital, both GPs and LPs, make decisions. I'm Beezer Clarkson, your LP co-host from Sapphire Partners, where we aim to invest in exceptional early-stage venture capital managers ranging from emerging to established franchise VCs. And here to help me unpack my recent conversation with Thomas Kristensen from LGT Capital is once again my partner at Sapphire Partners, Laura Thompson. Thank you so much for coming back on the pod. I'm excited we get to continue our mini-series on franchise funds, even though what I thought was really interesting about the conversation with Thomas, and we can dig into this. While we started talking about franchise funds, we quickly evolved into actually covering a range of more, I would say, general venture type topics. Any case, it's super pleasure to have you here with me. I'm excited for our conversation.
Thank you so much for having me back. It's great to be here. I do have to apologize. I have a big cold, so sorry to you, sorry to the world that I sound a little bit funny, but I'll try and minimize it. Yeah, and I'm so excited to unpack exactly what you said, both a little bit about franchises and then also some really, really relevant topics in venture right now.
Let's talk about secondaries, because I loved his comment. I'd be curious how you responded.
I guess I'm just negative today. I'm like, oh my gosh, venture is so broken. Aren't we supposed to be investing in these like underlying companies who like want to go public and want to be public companies and like aspire to that? And like, is it like, how do we, it's above my pay grade, I think, to fix this one. But I did love his point, which is we haven't seen a $500 million fund be returned, in this way. But also we need to think about it and, see and have open dialogue about it. I'm curious what your reaction was.
Oh my goodness. I love how you worded it. It does feel like venture is broken because the exit was always presumed to be the point of the journey. But if now being public is so unattractive to CEOs, I've been sort of fighting that internally, but maybe what Thomas is saying is the path, which is that we just need to evolve, and evolution is hard and scary. And I don't know enough, but I'm going to wager a bet that the secondary market is not as deep as the public market, because that public market's in trillions. And I just don't think the secondary market's in trillions. But is it sufficient to get you at least a 1x on a $500 million fund? Because we know we've got some smaller funds who have been successful in doing that. And then once you get to a 1x DPI, it changes the game from a return perspective pretty significantly. I'm open to it. We need alternatives. What's hard for me is if the venture industry is structured soup to nuts around presuming these exits in certain markets, does that then mean we have to change things like how carry works and what do you do with your options? And it might trickle down into other areas that we haven't fully fleshed out. And this is definitely more of an LP worry than other people's worry. If we don't have exits for another year or two, I think there will be a lot of challenges in fundraising that have not yet. We're feeling it, but it's going to be incredibly acute.
I completely agree. We need companies to go public. And, I love your point about the 1x, but, at the end of the day, like we need the 5 to 10x funds to offset the funds that aren't. I think some of those big multiples do need to come with the public exit. So I don't know what, I completely agree. We need to evolve, and it might just be an ongoing part of fund management and the strategy, but I don't know if it can be the strategy unless you're a very, very small pre-seed or seed fund.
It doesn't feel like it's there yet. And there's other component of secondaries, which we didn't get a chance to get into with Thomas, but there's a whole bunch of secondaries that go from essentially the LP pocket, right? Because the LPs have put money in the funds and the funds invest in companies. So when CEOs and employees take secondaries out, that money never circulates back to the LPs. That's just more money going out of the system and not coming back. So that raises the bar on the size of the exit needed.
I don't know how to fix that either.
Neither do I. But thinking about it. But maybe, but I'm hopeful that if we have options in creating exits, then that might add up to the numbers that we need.
Yeah, and I do think we need to be creative. And to your guys' discussion, GPs need to evolve, LPs need to evolve, and we need to figure out how to make this asset class work in these conditions.
We've done this now a couple of times with different LPs, and what in that context stood out to you that Thomas in particular may have spoken about that others haven't?
I just love his insights, I have to say. It was just a fantastic discussion to listen to. And, he commented on that 3 to 5x over time and the difficulties of maintaining a franchise. One thing that I thought was really interesting was his point about really kind of reinventing yourself or needing to stay current in the market. And, as an LP, I think sometimes LPs don't love big changes. And I was just curious, kind of what your thoughts are, like when you've seen folks make changes that have been in the positive category and where that's been effective. Because I was trying to reflect on the same thing. Because I'll just own it. When we had people who had never done crypto going into crypto at maybe generalist firms, that could be saying like, hey, there's a part of the market we need to participate in, but it also gave us some pause in some situations. So I'm just curious if any examples came to mind for you.
This was pre-COVID, but I remember the point when everything was crypto. And everybody, you'd get your coffee, it's going to be a crypto coffee token. And every LPA all of a sudden got updated to have crypto. And candidly, I sat there and thought 95% of you are never going to do any of this. But it felt like that was how venture was getting done. So everybody responded. And then Thomas's voice overlay was, yes, but know why you're doing it. Pick the right people. Be purposeful. That wasn't how he said it, but it was definitely a be purposeful in your point of view and why you're doing it. Because we've seen lots of times, not just in crypto, where people expand on a strategy and it doesn't work out well. But the times when it does, I would echo what Thomas said. People really thought about why they were doing it, even if it's a competitive response, because if we don't, our market's changing. And if we don't do this, we're not going to be successful.
I think that struck out to me was, the idea of generating top returns over time, but knowing there's going to be some really difficult vintages. Mm-hmm. And I was thinking about it as it pertains to our emerging manager community, because if you started a firm in 2019 or 2020, like that might just be bad luck. And then yes. I think what you guys discussed was other signals. And so, I think, maybe some of the listeners would love to hear, like, if a vintage is not standing out, like what has to be true? Like if it's clear that like a fund one or, is really not performing well, like what else has to be true?
It's going to be a toughie. My heart breaks. The numbers are definitely showing that funds that started 2019, 20 are having a tougher time fundraising. It's always hard, right? The attrition rate between 1, 2, and 3, and 4 is always tough. But I think in particular, because the metrics aren't there for some of the companies, it's even tougher. So Thomas was talking about this, about the communication and the transparency and the being willing. I'm going to tie this to two things he said. I loved what he said about being a great investor, right? That you obviously need to be a great picker. You need multiple skills. You need to pick, you need to win, all those good things. But you also have to have this element, he said it's sort of being paranoid and willing to constantly learn and work hard at both those things. Which actually we've heard from some of our direct investors as well and other podcasts. I like the fact that there's a consistency in what the best do. But I think that ties into then what do you do if you're in this kind of awkward teenager years of emerging manager in essentially a crappy market? Can you communicate your way out of it? I think you have a better shot than not. I think what Thomas and I were also talking about is the adverse of that. There's this line between sharing with your LPs, here's what I learned, here's what I'm doing better, here's how I'm going to work with my companies, and then also being so transparent on all the negatives. There's not enough positives to give faith for the future. But if you hit that line right, I think LPs have a lot of capacity to feel welcomed and to come back, assuming they have capital, which is a separate conversation. I think GPs could lean a bit more into that. I'd be curious to get your take on what is that line between here's what I learned and don't terrify your LPs with all the bad news.
I totally agree. I feel like it is transparent and it is, I love what you guys talked about the self-correcting that you mentioned, because I do think GPs are on the front line. LPs hear about it later. So like having the awareness of saying like, this part is not working or this element needs to be changed is huge. I think the reality is, I think the communication in this situation can help with existing LPs, but it's particularly hard with new LPs. Because if you don't have a long track record and you haven't seen it working, it's hard to join a new fund. You also have to spend a lot of time forming the relationship and hearing about these learnings, and LPs have pretty limited time. So I think it can work with existing LPs, but I think it's hard to get new LPs in a situation like this for emerging managers.
I have some examples in my head where that is so true, that the leading with the negative message or the learning message with new LPs can be a much harder way to build momentum. And there must be a new way of packaging it that's more productive.
Well, it's just hard because if you don't have some like blockbuster funds before the learnings, then it's unclear if you're a good investor. Like if you're an emerging manager that just happened to enter in the market at a very difficult time. You might say, here are the learnings, but new LPs might be like, well, where are the really high potential investments? If they're to come, we might want to see it for a cycle.
Yes, I think that is the bummer news. I'm also wondering about something Thomas said about the founder product connectivity, and if emerging managers can use that to their advantage. Because one of the things that I think you and I really appreciate about the emerging managers is there is a newness and a freshness to I'm engaging in a population or an ecosystem that sometimes people have just freshly come out of, or they're looking at things in a new way because, I don't know, let's just pick on AI. If you've grown up in AI most recently, you may have a more nuanced operator, here's what's happening today sense than someone who may have not done it for the last 15 years and has to learn in real time and reintegrate that into their portfolio and reintegrate that into that firm. How do you convey that message to your advantage? Because you're just not going to have the company data points yet because they're 6 to 12 months old.
I love that. It's a great question.
I don't know. We'll see.
We'll see.
Well, thank you for joining us despite having a cold. I really appreciate you coming on and spending time. I love hearing your insights, and both on the pod and in these Sapphire rooms.
Well, I so appreciate being part of it. I'm sorry I sound horrific. Hopefully, after lots of tissues, it will resolve itself. But no, I love the discussion today, and yeah, just feel grateful to be part of the podcast.
Thanks for listening to the Minisode of Origins, the show where we discuss the venture capital ecosystem through the lens of a GP and an LP. Though in this episode, you got 2 LPs. We'll be back soon with our next full episode of Origins, where we'll be talking with Nina, a partner at Index Ventures. And with her, we'll dive deep into her origin story with the founders at Service Titan, dating back to their college days and then journeying along with them through IPO. You can find that right here in this feed. And while you're there, please rate and review the podcast. It's super helpful for other folks looking for venture insights to find our show, and really helpful for Nick and I to know what you like and want more of and what you'd like us to do less of. I'm Beezer Clarkson, and on behalf of my GP co-host, Nick Charles, we'll be back soon. Thanks for listening.